Hello, and welcome to Portfolio Matters, weekly markets checklist, week 198. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
Well, we've got a packed week this week, and I have prepared a very long section on the oil market, which I think is really important, but which we're not going to have time to get through this week. So we will have another podcast next week. Thank you, Richard. So the news, it's been 3 weeks since we last had a podcast, and a lot has happened. So a renewed trade war has kind of broken out between China and the US. China threatened new restrictions on rare earth metal exports. Trump then retaliated with threats to impose further tariffs of 100% on Chinese imports. Equity markets took that badly, but then a sort of truce broke out. Trump very quickly tweeted that it was all going to be okay. And over the weekend, talks in Malaysia have led markets to anticipate that the current trade war truce will be extended when Xi and Trump meet in South Korea later this week. The US has, and I was surprised about this actually, the US has imposed further sanctions on Russian oil companies, Rosneft and Lukoil. So, you know, all the conspiracy theories about Trump being in the thrall of Putin seem to be missing the mark.
He's fed up. He's completely fed up with Putin, isn't he? Who clearly is saying one thing and doing another.
Exactly. So he's also been providing information to the Ukrainians on and support, allowing them to hit Russian oil infrastructure. So he's becoming firmer with Russia, I think we can say. So that will mean that buyers of Russian crude will be excluded from the dollar-based financial system, and has led to purportedly Indian buyers are thinking about cutting their imports of Russian crude. That led to a jump in the oil price of almost 9% on the news, but that's unlikely to last. History suggests Russia will use its dark fleet to circumvent any restrictions.
I think it's probably made it harder, hasn't it? But not impossible.
Yeah, over time they'll find a way around it. They always do. Yeah. So Trump has imposed further 10% tariffs on Canada after the state of Ontario broadcast an advert he didn't like. Yeah, seriously. But we'll show you the data. In reality, that has very little effect on Canadian exports to the US because 90% of them are exempt from tariffs. In France, the government struggles on. Reinstated Prime Minister Sébastien Lecornu has suspended Macron's pension reforms, which was his great achievement, until the 2027 presidential election. But by conceding to the socialists, it's left them asking for more. So now they're demanding higher taxes on billionaires, otherwise they'll bring down the government. But political instability in France continues, and Moody's have put their credit rating on a negative outlook. In Argentina, Javier Milei won the midterm elections. Hurrah! So, giving him a mandate for further reform. The US has pledged $40 billion in support. The US government shutdown continues and is currently the second longest, and according to betting markets is firmly odds on for being the longest in history.
I read yesterday that the government won't be able to pay military salaries by about the 15th of November.
In banana republics, that's always a bad move. Let's see what happens. Now, this morning, the FT is reporting that the OBR is set to downgrade UK's trend productivity growth by 0.3% per annum, which is enormous, and will deliver a huge blow to Rachel Reeves ahead of the budget. Now, each 0.1% downgrade of GDP growth increases the deficit that she has to fill this parliament by around 7 billion. So the Chancellor is likely to need to cut the deficit by 30 billion, which means big tax rises, almost certainly income tax. Be warned. Personally, and we've talked about this before, I think the establishment, like the central bank and the OBR, have been really good to the Tories and bad to Labour. Labour have inherited a mess that they got from the Tories. And the OBR should have downgraded UK growth years ago. And the Bank of England has been subsidised the Tories through QE and is increasing the budget deficit for Labour due to QT.
Mm.
Now, I wanted to get your opinion on this, Richard. In Germany, retirees will be allowed to earn up to 2,000 euros a month tax-free in order to get them back into the workforce. So there's precedent for this. In Greece, pensioners pay a fixed 10% tax rate on any additional income above their pension, and that has resulted in 200,000 of them returning to work since 2023. So this is a very effective policy, but is it fair? So essentially, you're asking younger workers, they have to pay tax to pay the pensions of the older workers, who then get a much lower marginal tax rate. If the two people are working in the bar, one's 30 and one's like 70, one is getting a guaranteed income from a state and then paying no tax, and the other is paying, 40% tax and a much higher marginal rate. Is that fair? What's your thoughts?
It's a very good question, isn't it, Keith? But well, on a superficial level, it works to get people back into the economy, increases economic activity, which is good. I guess the question then is there a better way of achieving it than, as you pointed out, that sort of lack of fairness? And I suppose, in reality, the better way of achieving it is to say that, I don't know what the individual rules are, that a retiree who is in receipt of state pension doesn't jeopardize their state pension by going back to work, but pays the same rate of tax as they would if they weren't a retiree, and that the net increase in tax take by the government should be used to reduce all tax rates. And that would feel like a fairer way of doing it. But whether that would then have the desired effect of getting, because part of the purpose of a tax system is to incentivize people to behave in a particular way, whether that would have the desired effect in terms of getting more people back to work, I don't know. I mean, I think I'd take it a step further, actually, and say that all of these countries, the UK included, the tax rate is at such a high level now that it disincentivizes economic activity. And fundamentally, governments need to get to grips with reducing tax rates, which means reducing their involvement in society. And until that is done, we continue on this downward slope of downward spiral of government debt, government regulation, low productivity, etc. So I think it's,
I agree with that, your latter point. To me, I think this is unfair. And I think this is a further example of, the gerontocracy in action. So old people, increasing part of the electorate, and governments giving them sweeties to get them on side. Previous podcast, we were talking about private credit and jitters in the private credit market. Well, we've had further jitters over the past 3 weeks, though the equity markets have since recovered. In the US, Zion Bancorp took 50 million write-down, citing potential fraud at 2 corporate borrowers. Western Alliance stated they had initiated a fraud lawsuit against one of its unnamed commercial real estate borrowers. The bank said it believed the collateral covered the loan, but the shares sold off anyway. The market is nervous about private credit and banks' exposure, which has grown enormously over the past 10 years. We have a section on that coming up. Market news. Equities continue to march higher, helped by the prospect of interest rate cuts. More on that later. The bond market seems to have reached a peak and yields are coming down, he says. Fingers crossed. Precious metals have had an incredibly volatile past 3 weeks, but gold is net flat, believe it or not. Richard will have more to say on that. Commodity markets, well, cobalt has had an absolutely astonishing 3 weeks. It's up almost 50%. Aluminium has had a good week. It's been very mixed.
Cobalt's up 50%. I must have a word with my children because they're working out there, so they should be able to send me more money home.
What, in DRC?
Yeah, they're working in the mines.
Yes.
That's why you have children, isn't it, Keith?
Yeah. Well, I wish mine provided that much income. That should a money sink. But you've inspired me. I'll send them to the DRC. I thought this was true. Basically, this year we've got a section on where we are on the tariffs coming up, but it's on off. Everything seems to be on Trump's whim. I mean, the 10% extra tariffs on Canada. I mean, seriously. So the IMF has upgraded its growth forecast for 2025, but it marginally downgraded its forecast for 2026. Pause and take a look. And it warned that AI investment in the US was shielding the economy from a sharp slowdown. Now, we have yet to have Q3 earnings from the AI companies in the US. Watch this space. US loan growth, we've been talking about this section coming up, has not been particularly high. You're looking at the purple line. So we don't think there's actually that much trouble in private credit. The trouble is, when you look at the percentage increase in lending to private credit, it's enormous. In absolute terms, it's not that great. 300 billion. That's only 10% in total of the US economy. Not enormous. Meanwhile, in France, political turmoil continues. Rating agencies are getting worried. And the Moody's is the latest one to downgrade France's credit rating from stable to negative. Now, crypto markets had a bad few weeks. And this is really interesting. So this is on the 10th of October, I believe. And essentially, someone in the Trump administration knows what's going to happen. And there's enormous insider trading in crypto markets, which were entirely unregulated. So before Trump announced his 100% tariffs on China, which upset the market, somebody had started selling crypto big time. And then they bought it back and they made a mint. Now, price action in crypto, like this is the official Trump coin, huge drops. Some of them dropped up to 50%. This is Dogecoin. I mean, why there's any value in these things at all remains a mystery to me. Some shit coins fell 50% on the day. Look at Pepe, and they haven't recovered, but meanwhile, gold, which is a proper store of value, shot up, shot down, net result, it's flat. Nothing happened over the past 3 weeks. We'll take you through the charts in the meantime. Okay, and on the US government shutdown, quickly. Well, this is previous government shutdowns. The longest was also under Donald Trump, and that was 33 days. As of today, we are 28 days and counting, and the betting markets think it will last another month. So the median bet is the 23rd of November. As Richards pointed out, they won't be able to pay the military, which is generally a bad sign. Now,
they could play them in Trump coin, couldn't they?
Yes, what a good idea, Richard. So federal workers have begun to file unemployment claims, and unemployment insurance continues to be paid during a federal government shutdown because it's managed at the state level. So what are the impacts of the current US government shutdown? Well, 900,000 federal employees have been furloughed. And what does furlough mean? It means they've been placed on unpaid leave and are expected not to work. A few of them, accepted workers, continue to work and will be paid in arrears. 2 million federal workers are continuing to work without pay. They will be paid in arrears when the government passes a budget and departments receive funding. Now, the pay date for federal workers this month was the 24th, and we're now past it. So 3 million federal workers have missed their first paycheck. That's quite a lot. That should have an economic impact, even if it's transitory. 4,100 federal workers have been laid off so far. And on to equities, Richard.
Thank you very much, Keith. So these numbers represent a 3-week change. So the FTSE All World up 2%, the All Share up 1.7%, Stocks Europe up 1.2%, S&P 500 up 2.4%, and the Russell 2000 up 1.8%, Nasdaq up nearly 4%, and the Hang Seng down 2.5%, Topics up 1.7%, Bitcoin down nearly 8%, up 23% on the year. The pound against the dollar down a little bit, 0.6%, but up nearly 7% on the year. Euro US dollar down 0.5%, up 12% on the year. And the dollar index up 0.5%, down 9% on the year. And the VIX down.
Yep.
And all of the world's stock markets are showing between 10 and 30% increase year to date.
Yes, new highs for most of them.
And there's the FTSE World Equity Index.
Yeah, no Q3 jitters.
This is the FTSE All Share Index, the Euro Stoxx 600, S&P 500.
New highs, just continues to grind higher.
Yeah. The Nasdaq Composite, same thing. The Russell 2000. The Hang Seng, Topics, Bitcoin.
Yeah, equity markets just grinding relentlessly higher.
Yeah. There's pound against the dollar.
So dollar weakness seems to have peaked. The dollar's actually been strengthening a bit.
Yes, I agreed with that. And the euro against the dollar showing basically the same shaped graph. Dollar index.
Yeah, seems to have bottomed.
And the VIX.
Dead as a dodo.
And then the weekly change in global liquidity, which is still expanding, but expanding at a lower rate than it has been in 2025.
Now, we've got a section coming up talking about why the Fed may halt QT next week. Now, if it does that, then liquidity may start to rise again.
And showing the looseness of financial conditions, and if they stop QT and reduce interest rates, then financial conditions will become even easier.
Yeah, and that should support equity markets.
Yeah, and Bitcoin, etc.
Yeah.
S&P earnings growth has been strong, and analysts expecting earnings growth to re-accelerate in 2026. I mean, there's no evidence that these people are expecting a recession, is there?
No, that's right. To be fair, they always expect things to re-accelerate, and then they kind of guide them down over the course of the year.
Yes, but they've not really been wrong for the last few years, have they?
No, that's true. There's always been stronger than expected.
Yeah. And we've got a margin expansion is basically driving the rise in the S&P, which is a sort of expectation of future earnings, probably.
Yeah. It should be multiple expansion, sorry, not margin expansion.
Yeah. New York Stock Exchange margin debt is basically at its highest level.
Yeah. So everyone, so basically it's 2 year rate of change, but everyone is piling in.
Yeah, which is always a bit of a dangerous situation. And seems to be followed by a sharp fall on that chart. Fund managers are all in, haven't really got very much cash at all.
Yeah.
And companies that do buybacks perform better than those that pay dividends. It is an indexed return. So it's not just the share price, it's the return.
Yeah. So I think what's going on here is that the tech companies do buybacks and value stocks do dividends, and value has obviously underperformed growth massively the last few years.
Yeah.
The market, these are the revenue projections for OpenAI, which go from 13 billion now to 200 billion by 2030. Now that is a huge assumption, extrapolation of what revenues OpenAI could get. Now that includes 77 billion of non-subscription consumer revenue, which just is enormous compared to.
That's advertising revenue, presumably.
I don't know what that is actually. It's like, what is that? But it's just like, it's absurd. Those are huge numbers, including new products which haven't been invented yet. So, but to be fair, when you look at Tesla, it's got a market cap of 1.4 trillion. And, revenues are actually, revenues have been increasing, but earnings have been declining for years now. And so, these kind of expectations about the future can last for years, despite, any evidence to the contrary.
Okay, yes. So AI companies have gained over $1 trillion in market cap over the last year, led by OpenAI and Sam Altman, who has done vast numbers of deals recently, hasn't he?
Yeah, given he's got 15 billion of revenue this year, and he's committed to, like the Oracle deal alone was 300 billion. That's absurd. The market is assuming that he's going to get a lot of money from somewhere.
This is the point. So yesterday I was doing I was interrogating Claude, which is Anthropic, isn't it?
Yes.
And I was asking it about the future of AI systems when humans are wary of them, and the future of humans when AI systems are wary of them. I sort of put two sides of the same question. And at the end of each one, it said, "What do you think?" And I thought, no, this isn't about what I think. This is about what you think. But clearly, it's trying to get information off me to put into its database, so it then starts to find out what we think.
Well, the thing is, Richard, I think it's just developing social skills. It's like
didn't ask me how I was feeling, please. How's your bad back, Richard? He said. I thought, how do you know about my bad back?
Yeah, well, there were limits to its patience, Richard. It's like.
He said, for God's sake, shut up about your back. But I don't. Anyway, so this is what's this chart showing us? Please?
Well, this is the only chart you ever need. Okay, we've done loads of sections on this, but the future returns of equities are a function of allocations to equities. Yeah, and essentially, what's been driving the market is people putting more money into equities. Now, this tends to be long-term mean reverting, and when allocations fall, future returns collapse. So this is a warning sign. But we've been saying this for years now, and markets have been marching higher, and everyone keeps on putting more money into equity markets. So the assumption that is long-term mean reverting is, it has been in the past. Will it be in the future? Well, it's a long-term chart.
I mean, if you look at 1980, it was low. 1995, 2000, it was high. And so that mean reversion cycle took 30 years, and we are currently 15 years into the into the next cycle.
Yeah, that may be true. So, it could march up to even higher levels, but, household allocations to equities, an all-time high.
So our advice is, if you sell the S&P 500, but it may take 15 years before you see any return.
Yeah,
and that's not our advice. That would be foolish.
Yeah, but anyway, I also think this is a function of inequality. So, inequality has been rising in the US, and wealthier people have more money to put into equities.
Yeah, so true. So November, traditionally a good month for stocks. So we're nearly in November. We shall see.
Yeah. And on to commodities. Thank you, Richard. Quick summary. Energy, well, it's been a very volatile 3 weeks because of the US sanctions on Russia. But at the end of that, oil is kind of flat. Industrial metals, generally strong, led by cobalt, aluminium, and zinc. Precious metals, incredibly volatile. Huge spike, then drop again. Net gold is net flat over the course of the 3 weeks. Silver net down. We'll take you through the charts. Okay, energy. So Brent, after big spot, well, actually big drop and then back up, is kind of flat over the past 3 weeks. WTI down a bit. Natural gas in Europe and the UK still drifting down. That is fantastic news for consumers as we enter autumn and central heating has been turned back on. US natural gas futures down 2% over the period, coal down 1%, uranium down 4.1%, but uranium is the only energy commodity which is up on the year. Others, such as nat gas, down 38% year to date. Not great, but good for consumers. So this is Brent, was drifting off as the market becomes worried about a glut next year, and has jumped back up because of US sanctions on Rosneft and Lukoil, but I doubt that is sustainable. WTI, similar. Numbers specific to the oil market. Well, there have been crude draws over the past 3 weeks in the US. US oil production, however, has hit a new high of 13.6 million barrels. I really wasn't expecting that. Up on the year now, and that is despite falls in the rig count. Now, the futures curve, you're looking at the chart to the right. 1 week ago, it was expecting oil prices to be around $61 for the next 6 months and then rise, but not be below $65 in 3 years' time. And the whole curve has shifted up. So they're expecting the US sanctions on Rosneft and Lukoil to have some effect, but oil prices to remain subdued. Natural gas futures in Europe going nowhere. Hurrah! UK, very similar story. US natural gas futures, well, up. Actually, the past 3 weeks, it's kind of flat. Now, the thing is, demand from data centers is due to grow. And most of that is going to be gas, and most of it is going to be pretty inefficient gas. So these data centers are not combined cycle gas, but just simple gas, your gas turbines. And you can see the grey bar at the bottom here. US electricity generation is going to rise a lot, and a lot of it is going to be led by gas. So you'd expect demand for gas to keep on increasing. But previously, of course, we believed in the energy transition, which was leading to lower gas use, and gas turbine manufacturers had actually cut back on capacity. Now we've had a total reversal of that, and as a result, although data center although data center constructors would like to buy lots of turbines, there's actually limited capacity. So the rate at which they will be able to grow their data centers is open to question. You'll see that orders are going to exceed capacity for the next 5 years. That is the rate determining step. Onto coal, flat. Uranium, that trend is still intact, rising trend, he says.
I would say it is, but it's a quite a gentle rising trend, isn't it? But quite noisy.
Yeah. And onto industrial metals, Richard.
Thank you, Keith. So big change for aluminium on the week, up 6.1%. I don't really know why that would be. Cobalt, as Keith says, up nearly 40% on the week and doubling for the year. Copper is now up 27% on the year, 1% on the 3 weeks, I beg your pardon. Iron ore 1.1% and 1.9% week and year. Lithium up nearly 7% on the in the 3 weeks and 5% for the year. Neodymium down 14% in contrast to cobalt, and up 35% on the year. Nickel down 1.3%, nickel almost unchanged really. Tin down 3%, but up 23% on the year. And zinc, like nickel, not really very much change either week or year. So aluminium has been on a steady upward march since the spring.
Yes, absolutely. Well, that is basically pure electricity, isn't it, aluminium? So
yeah, and apparently it's used in long distance power transmission because it's lighter than copper.
Yeah,
cheaper than copper.
Yes, good point.
There's cobalt, for which is it because of the quota system from the DRC?
So we talked earlier in the year about how the rise in cobalt was because the government in the Democratic Republic of Congo had essentially limited supplies of the metal. It's been in glut because it's a byproduct of copper manufacturing, copper mining in the DRC. So now what they've done is announced a quota system for the rest of the year, which will further limit supplies and hence the price is rising. But the cobalt market remains fundamentally oversupplied, and the high prices will last only for so long as the DRC restricts output. Now, the longer this goes on, the more, basically the more opportunities for corruption, etc., and supplies leaking out are created, and I just don't think this is sustainable.
Yeah. There's copper, iron ore.
Actually, well off its lows.
Yeah. Lithium moving back up significantly, actually, over a number of months. Neodymium.
Yeah, now this is rare earth restrictions and the fact that there's a truce being negotiated.
Yeah.
So the market is expecting neodymium to come back onto the world market, I think.
There's nickel, which is essentially flat for the last 6 months. Tin, zinc, and precious metals. As Keith said, there have been some very big changes over the last 3 weeks, which aren't reflected in this. So the change of 0.4% doesn't reflect those big movements in gold, about 50% year to date, silver, 61% year to date, platinum, 72%, rhodium, 76%, and palladium, 55%. I mean, I think it's over the last 10 days or so, gold and silver had this enormous unsustainable run up where the price went sort of temporarily parabolic, and it's all dropping back down to a more sensible level. And I think that was probably caused by a sudden influx of retail investors into gold and silver. My personal view is that there's a long way further to go in the pricing of these elements, but that this pullback has to happen because a lot of people just jumped in and it became very frothy. I think central banks will continue to buy for several years to remove themselves from the vulnerability of the dollar system, not for a gold standard, but just to remove themselves from that vulnerability. And I think that the investment advice that has come out from various banks that individual investors should have a gold holding will start to gain traction over the next few months. So it's just a question of holding on, letting it all drop back down to a more sensible level and being patient. And maybe there's going to be a few months consolidation now. We won't see anything very much happen once this particular bounce and sudden drop settles down. I noticed today the prices have dropped again. It is option expiry today, actually, on the gold option market, and there's a lot of shenanigans go on with option expiries anyway, as we all know, to manipulate prices to the best effect for the people who wrote the options. So option expiry is always volatile.
Investing is about having a strategy and sticking to it, and so you're sticking to it.
Yeah.
I also listened to a podcast talk in which they invited a gold dealer on, and he was saying that in previous oil bull markets, the moment the oil price, so that in previous gold bull markets, when the gold price had risen, you got a lot of people bringing in their gold jewelry to take advantage of the higher prices.
Yeah.
And he said he was seeing nothing coming in.
That's
And so he was basically saying that, people think this has got legs. So the punter is not cashing in. He's got further.
I mean, I think also anybody who has any sort of awareness of what's going on in the economy knows that our governments collectively are screwed, that the debt levels are far too high, that the currency is being debased by inflation, and they know something's wrong. They may not really know what's wrong or how to fix it, but they know something is wrong, and that makes them start to look around for how they might be able to do something about it. And that's it's a very sad situation that we've got ourselves into this gigantic mess, completely unnecessarily. So there we have gold, gold and silver, we just discussed, gone parabolic, but it's just going to drop back down and then resume, I think, over the next few years, its steady climb.
Right. Yeah. So this is the media interest in debasement, and it's obviously gone through the roof, and then punters are piled in.
I suspect quite a lot of margin has gone into buying gold on the exchanges. And what's this one saying, Keith?
Well, this one's basically saying that if the markets were worried about monetary debasement, the yield on US Treasuries would be rising sharply, but it ain't. So, punters are worried about monetary debasement, but the market's not.
It's a bit of a sort of a disconnect, isn't it? Because monetary debasement is clearly happening because that's what inflation is.
Well, inflation, we've got more on inflation coming up.
And this is a comparison of where gold is compared to the black line of the 1980s. So fasten your seatbelt. No, I don't mean that. But gold has potentially got further to run. And Shanghai data suggesting that physical gold ownership has risen by 25-fold this year. So China is very keen on its citizens owning gold, and they enabled insurance companies to buy gold as well, and they can own up to a certain percentage of their assets in gold now.
Really?
Yeah. So China is very keen on basically removing itself from any dependence on the dollar system.
That's true, but the Chinese, and I know this because I'm half Chinese, they are big gamblers. And so, the very fact it's going up, piling in. But, they're fickle.
Yes, I'm sure that's very true, Keith. US ETF, the little grey line, holdings below their 2022 levels, which means that public interest hasn't really got going behind gold. Which is also interesting because I think if people do start to say, well, I want to have 5% of my portfolio in gold, then there's a lot of purchasing power out there.
Yes.
And central banks continuing their buying spree. I mean, central banks are very clever buyers as well. They will buy steadily and continually. They buy secretly. And when the price spikes up like this, they will stop buying and now wait for it to fall back down.
Well, when you say central banks are clever, Richard, Do you remember what the Bank of England under Gordon Brown did? You know, the brown bottom, as they say.
I despair, Keith. I
Yeah.
just hope that in amongst all of that central bank buying, the Bank
Yes.
of England is buying.
Not sure we can afford it, frankly.
Well, we can print. See what we. The process is this, Keith. You print pounds with QE,
Yeah.
convert them into dollars, and you buy
Yeah.
gold.
Mm.
So this is gold is a tiny market. If you get serious allocation of resources towards into gold, then and the gold complex generally, then the price has to rise very, very much, very significantly in order to achieve that allocation levels. That's what has to happen if, and there's all these big ifs, and there's timing. And the other thing about this is really important. You have to understand and cognitively believe to be correct the thesis. And this is the same with any investment, isn't it? If you don't believe the thesis and you don't understand it, then
Yeah.
you will not be able to stay in when the market gets rough.
Yeah.
You may be wrong.
Mm. Well, I know all about being wrong recently, but we'll be right again at some stage.
And then this is a comparison of the current bull market with the gold bull market with previous gold bull markets, which is suggesting there is room to run. It's interesting that little sort of almost vertical line in green that we see there. You don't see many of those, and when you do see them in these other charts, they fall back.
And yeah, just like if you look at the purple line, there are plenty of these in a longer bull market.
Yeah. And there's silver, which basically is sort of reflecting what gold's doing. It's a little bit like the tail of the dog. And Indian spot silver prices soared over benchmarks, basically because there's a shortage of silver where it was. I don't think there's a generalized shortage of silver overall, but there's a shortage of silver where purchasers are in the world, and it's having to be shipped around the place. Apparently, there's ample supply of good delivery bars, but the mints can't convert them into coins fast enough.
Right. Gotcha.
And then platinum year-to-date change of 72%. So platinum basically, in comparison to gold, historically is very undervalued. And I think the play there is for an equalization, a reversion to the mean, as rhodium and palladium. Looks like gold on steroids there, doesn't it?
On to rates. Thank you, Richard. So great news. Over the past month, there's been a substantial shift down in the UK yield curve. Now, you'll notice that the 2-year, the 1-year, has really not moved at all. And the 1-year basically bottoms at 3.75%, which I find just astonishing. Now, short-term rates, your short-term bond yields should be well anchored to average interest rates over the period. Now, UK interest rates currently 4%. The market is discounting a 60% chance the Bank of England will cut again in December. And then the bond market is saying they won't cut again the whole of next year, which I think is just wrong. That should be at least 3.5 or probably lower, frankly. But anyway, the shift down in the yield curve is very good news for me and also for the government. So that helps Rachel Reeves. A similar story in the US, but you'll notice there's been much more of a shift down in the 2-year in the US. The market thinks that inflation in the US is more under control than the UK. This is the US. The markets are expecting a whole 1% of cuts in the US over the course of the next year, whereas in the UK they're not discounting they're discounting 0.25% of cuts. Seems wrong, frankly. And US 1-year inflation expectations have fallen back towards their pre-Liberation Day levels. So markets are becoming less concerned about the inflationary effect of tariffs, and they think US inflation is actually coming down. We'll take you through the latest CPI numbers in due course. This is the UK 2-year. it's come down, but still from very high levels. That's still 3.8%. That's really high. UK 10-year, that is a big drop, but we have been here before. All eyes on Rachel Reeves. What's she going to do in the budget? UK 30-year, big move. Have UK bond yields peaked? We hope so. This is the US 10-year. Actually, there's been much more of a systemic move down in the US. Bonds yields there peaked back in January. Now you'll notice that the UK bond yields are much higher than in the US, and the UK has a plan for tackling its deficit. The national debt is 100% of GDP, not 124%. So, if the UK can get inflation under control, then I firmly think that UK bond yields should fall below US bond yields, which implies bigger further drops. Let's see what Rachel Reeves does. This is Germany, kind of flat. France, down a bit, but France has got a political and fiscal problem. Italy actually in much better shape. Greece. Japan, has that peaked? Actually, the market is expecting more of the same in Japan. So they're expecting that the Bank of Japan will not be raising interest rates as much as previously under the new Prime Minister, and the Bank of Japan to keep on buying bonds. Okay, and on to this week's economic data. Quick summary: UK stagnation, but turning into stagflation now. Inflation has hit a near-term peak. We'll take you through the data. The economy is weak but stable. EU stagnation. The US fine, but the labour market is softening. Now we have a section on that coming up, which is really important. And then China, well, the latest data is contradictory. The headline data shows the economy doing fine, but China is in deflation, so I don't see how that's compatible. On to the UK, Richard.
UK CPI month on month, September was unchanged, which is better than expected. Year on year, September was nearly 4%, which is as expected, and which is pretty bad.
Yeah, but remember, the Bank of England was forecasting that UK inflation would peak at 4% in September. And so hopefully this is a near-term peak, and
Yes.
it's been weaker, which is good news.
Yes. I hope you're right, Keith. UK core CPI month on month, again, unchanged in September, better than expected, and 3.5% on year, which is a bit less than expected.
Yeah, so actually it fell. So rather than being flat, 3.5%. That's much better than expected. So great news.
Yes. So I'm looking at it as a glass half empty, and Keith is looking at it as the glass is half full.
Yes.
So RPI month on month in September minus 0.4%. So down. And down more than expected. Year on year, 4.5%, which is, even with a glass half full, it's much too high.
Yeah, much too high.
And service inflation fell to 4.7%, so it fell, qualified, good news, but it's much too high to be compatible with the 2% inflation target. And bear in mind, the 2% inflation target is an invention, I think, of the New Zealand Central Bank about 25 years ago, and has no basis in economics other than that.
Well, the thing is, Richard, you need price stability, but what they found is that if you targeted inflation of 0, you actually didn't get very good in economic growth, because you need a certain amount of inflation, this is the theory, to allow sector rotation between industries, some of which would be doing well, some of which. So it's much easier because prices are sticky and wages are sticky. It's very difficult for wages to adjust downwards in failing industries. It's easier for wages to rise in successful industries and then people to switch jobs to higher wages rather than cutting the wages of people in industries that aren't doing so well.
So happy with that explanation, Keith, but empirically in the UK, it's not working, is it? We have low productivity. We have low, we're very slow to move into new sectors, and we have high inflation.
Yeah. The counterfactual would be if there was zero inflation, it might be even worse, So, moving on.
Food price inflation is slowing for the first time since March, just a little dink down. Hopefully it'll continue down.
Yeah, so this is where I thought this is really interesting. What you're looking at is the red line, which is 2025. And it shows the change in CPI, the CPI index over the course of the year. And the horizontal line is 2%. Now, what Simon French is saying is that if you exclude April, and you see that the red line jumped in April, then essentially the UK inflation is actually under control. The jump in April was due to the Chancellor raising taxes, in particular national insurance, etc., and mandating rises in lots of regulated prices, all of which contributed to that rise in April. But apart from April, the rise is compatible with pre-pandemic levels. 2014 to 2021 is the green line. So all the panic about UK inflation may be overstated.
That's interesting. I mean, it's a bit, just to come back on it, it's a bit like saying, if you take out this particular one-off, then we haven't got a problem. And each year you take out the one-off that you want to select that's going to have the biggest impact. And so I'm a bit dubious of the sort of intellectual consistency of that, because it is actually what people have experienced in terms of their cost of living.
Yeah, but the point is, Richard, if unless Rachel Reeves does the same thing again this year, which she may do, she certainly didn't learn the lessons of Liz Truss when preparing her last budget, but this time she has stated that she wants to help the Bank of England pave the way for further interest rate cuts, which would mean, hopefully, that she's not going to mandate further price rises and raise taxes in a way that lead to inflation. So, for example, if you do national insurance rises, which are taxes on businesses, those businesses will attempt to pass those taxes on to consumers, which is inflationary. If you just increase income taxes, that reduces demand, and that does not increase prices. Let's see what she does. Actually, can I do this chart? So a reminder of what this chart is, we've shown it before. This is a simple dropout model. So what it shows is the path of UK inflation if inflation just continues at a steady rate. So the orange line at the bottom is if you just add every month an annualized rate of 1%. The red line is annualized rate of 2%, grey line 3%, the green line 5%. And so what it shows is the effect of historic inflation dropping out of the inflation window, 1 year window. And so you see that if we follow the red line, which is the 2%, then it peaks in September and then comes down. So mechanically, unless inflation is persistently high, then September should mark a near-term peak. Now, if you think that inflation is closer to 3% annualized than 2%, then inflation will rise back above 4% in January. And certainly inflation will fall for the next couple of months, but then will rise again in January.
That's Interesting, Keith. Thank you. So UK input PPI month on month 0.1 in September, minus 0.1 in September, better than expected, and year on year 0.8% up.
Yeah. So input price inflation very low.
Yeah. Output PPI 0 in September, and month on month, and 3.4% year on year.
Yeah. We got charts wrong. I'll correct it.
UK earnings growth, excluding bonuses, 4.7% in August year on year.
Down, but not much, and still way too high.
And including bonuses, 5% year on year in August.
Yeah, not good. Actually, going in the wrong direction, still way too high.
UK 3-month employment change in August, up 91,000, better than expected. And actually, the employment numbers generally not looking too bad on that chart.
Yeah, but we do this every month, and I remain mystified by the UK employment numbers. So this is from the Labour Force survey. But if we go on to the HMRC payrolls data for the 3 months to end of August, and you add it up, payrolls fell by 12,500.
Do you suppose it's got something to do with self-employed?
Yeah, but they should be on the HMRC system, surely.
Well, not necessarily, if they don't pay themselves via a payroll.
Okay. Maybe you're right.
I just wonder. The UK claimant count, nothing much to see here, I would say.
Yeah, I agree.
And public sector pay rising substantially faster than private sector pay. Actually quite hard to see at the end, isn't it? All the lines seem to have sort of coagulated into a blob at the end.
That's true.
But public sector pay rises have been quite significant in the last 12 months.
It's a Labour government.
And the service sector wage inflation, as we discussed, is rather the service sector price inflation is high, and service sector wage inflation is also too high. But it looks like it might be dropping.
Yes, we have been here before, only for it to resurge.
Yeah. So UK GDP month on month was 0.1% in August, and year on year is 1.3%. I laugh, every day you see in the FT or whatever you happen to read that, you see two things, that Rachel Reeves and Keir Starmer are working incredibly hard to increase UK productivity. And what you actually see is there's a new regulator for this, or regulations for that are being increased. And it's like, guys, you don't get it really, do you? And all that they're doing is introducing more regulation that is going to actually adversely affect productivity. And they simply, I think they don't understand. I don't think they're bad people, but I think they simply don't understand. UK retail sales month on month, up 0.5% in September, better than expected, and up 1.5% year on year, which is better than expected.
The thing is, Richard, just to return to the GDP discussion, the thing, in the past few years, GDP growth has not been the priority in this country. When you look at, say, for example, the energy sector, we have been closing down high productivity oil and gas sector and replacing it with very low productivity renewables, because our priorities have been the energy transition in that case. And in the, say, construction sector, getting anything done in this country is impossible. So, for example, in the recent storms, we had a surfeit of wind power, and in order to get it from Scotland down to the southeast where it's needed, we'd need more transmission lines. But they haven't been built because the priority has been protecting the environment or people's perceptions of the environment. So if you want growth, you need to prioritize growth over other things. And actually, we like the status quo.
The other problem, I think, Keith, is that we constantly measure GDP, but not GDP per capita. And GDP per capita, within sensible confines, is a much better reflection of the wealth of the country than than GDP per se. And to me, this is a huge error in perception of understanding what the issue should be, and it means you drive for the wrong goals. And I suspect that's what Boris Johnson was doing. I mean, I don't think Boris Johnson ever understood anything about economics, but I think we need to have a proper understanding of what it is we're trying to achieve and how we go about achieving. We just don't have that. The debate is not a serious debate, and the Tories.
Yeah. Anyway, moving on. We'll be here forever.
UK industrial production month on month in August was up 0.4%, which is better than expected. Year on year is down 0.7%, which is worse than expected. So a bit meh.
Yeah.
UK construction output year on year 1%, which met expectations. And the BRC, British Retail Consortium, retail monitor year on year was 2% in September, which is a bit below expectations, but nothing remarkable about that, I think. Manufacturing PMIs, a big spike up in October, 49.6.
Yeah, so still in contraction territory, but barely contracting.
Yeah.
So I top at that.
And services PMI, 51.1, so that's okay.
Yeah, not great, but stagnation.
Composite, 51.1. Construction PMI, 46.2.
Not great.
Consumer confidence, -17, so bouncing along at a steady level for the last 12 months. House price index month on month in September was down 0.3%. Year on year was up 1.3%.
I'm surprised by this, actually, given that mortgage rates are coming down, he says.
I think people are uncertain, aren't they, because of what Rachel is going to introduce.
Yes.
I'm smiling because over on the left-hand column, we've got better. And how you can ever describe our PSBR as, in reality, as better. But UK PSBR was better than expected at a mere -20 billion in August.
Yeah, not good. You can clearly see the effect of the pandemic. We just got used to spending far too much money.
Thank you, Rishi. UK balance of trade, pretty ghastly. The UK, the Citigroup Economic Surprise Index at 23.4.
Yeah, so growth of 1.3% has surprised economists as positive, Richard.
No comment, Keith.
Yeah.
The Indeed jobs posting index has flatlined, I would say.
Yeah, I'd say that's true. It's not deteriorating anymore.
And UK wage growth average of 5.9% in September, which is a bit high in comparison to a target inflation rate, like below it, of 2%.
Yeah, this blood is awful. This is a terrible, terrible chart. If inflation is going to come down, that needs to be heading towards 3%.
So there's what I would point out here, I think, Keith, is that people, generally speaking, don't include tax increases in their inflation calculations, but you should, because what the individual bases there, what the cost of living on is their take-home pay, and when you increase tax, take-home pay drops. So I think, and then if take-home pay drops, then people look for pay rises, and I think that the sort of general concept that tax should not be included in inflation calculations is wrong. I think it gives politicians a free go, and I think one of the reasons for this is probably that people are feeling the pinch because they're being taxed so highly.
Well, that may be true, but people can demand pay rises, but if the business can't afford them, the business will just say no, go and get another job somewhere else. And
so there's a balance to be had, isn't there? Yeah. But it's also a question of whether you want to lose your valuable staff.
Yeah, but then somebody else has to be
bargaining power for your staff.
Yeah, exactly. But somebody else has to be willing to pay them higher wages. The trouble with the UK and why it's got persistent inflation is because it has, in the words of the IMF, got highly concentrated industries, i.e. the NHS, etc., which are where the employer is the government, and if you go on strike, well, there aren't any competitors, so
Yeah.
the government tends to cave in and raise growth.
Yeah, that's a good point, Keith. So household wealth in the UK over the last 30 years has soared due to rising property prices. So actually it's not liquid, it's assets. And property taxes remain constant.
Yes.
Will Labour raise taxes on housing? And if so, how will they do it? And I mean, basically, the taxation system on the housing market is grotesque, I think one can say. However you look at it, it's entirely grotesque.
It is.
It needs to be absolutely changed. And I think we can go back to Osborne and who started this ghastly trend.
Yes. I totally agree.
It's a complete disgrace.
However, Richard,
what she will do, though, is rather than fixing it, she'll make it worse.
Well, that is my concern, because what the media are talking about, we don't know whether this is true, but they're talking about a mansion tax of an annual rate of 1% on any value of the house above 2 million. So if your house is worth 3.5 million, it's 1% of 1.5 million, which is 15 grand a year. Now that's a lot. And if you are then, you have to pay that out of your income, and presumably your higher tax income.
Or your savings.
Or your savings. So that means you have to have income of 30 grand to pay the additional tax. And for viewers who are not in London, prices of houses above 3 million in London are really not very extraordinary. I had a quick look on Rightmove. 2 million will buy you a 3-bedroom new build flat in Nine Elms.
Wow.
Yeah, Nine Elms. It's like not a glamorous area of London. It used to be basically the home of, what are those gas things? The gas storage.
It was the marshalling. Oh, the gasometers.
Gasometers, yeah, gasometers and marshal yards.
Yeah.
So, this is basically a London tax. I think this would be.
I mean, it will just destroy the property market in ways that are very seriously damage the property market in ways that are very, very difficult to predict. Because the other point is that, say, take your hypothetical example of 3.5 million of property, a couple whose children have left home but they're still in that house, they'll want to sell that property. But no one will want to buy it for 3.5 million because of the tax implications and the stamp duty. So they'll be paying their, 5% of whatever, their, I don't know what the stamp duty is. They're £100,000, let's say, stamp duty, plus a £30,000 effectively gross cost of £30,000 a year additional tax. And they'll say, no way. So the housing market will crash.
That's true. But I would also say this is actually a very effective tax because it's very difficult to avoid. A lot of the other taxes there's a lot of avoidance. The thing about houses is people, there's very good title, etc., track record for them. You can tax people very effectively. And I'm not against higher taxes on property. But, if you're going to do it, I think it has to be equitable. So everyone has to pay, not just Londoners. And, you have to make it affordable.
I think, the problem with this government is that they are out of control. They don't understand the effect of they don't understand how the economy works. They don't understand the effect of their actions on the economy. None of them have ever run a business. They are they're totally out of their depth and they're flailing. Right, I'm just going to go and slash my wrists.
Yeah.
And then pop down to the casualties and bleed to death on the floor while they try and find some time to treat me.
Yeah. So this is an interesting chart, basically. So what it shows is the growth in UK in consumption in countries around the world. Okay. And the light blue line is per capita. And what it shows is since the pandemic, the UK is unique in that consumers have actually cut their spending and increase savings. So this is actually quite worrying when you think about UK inflation. Inflation has been very high despite UK consumers cutting back and actually increasing their spending, which what it means is UK consumers have resources, and if economic and political uncertainty in the UK were to fall, then you could see a surge in spending and a resurgence in inflation. Lastly, thank you to PHS and Sahil on our Discord, who are asking about what has been the contribution to the UK fiscal deficit of our support for Ukraine in the war. And the answer is a total of 21.8 billion over the last 3.5 years, which is only 6 days worth of government spending. So a decent amount, but not huge. So in summary, hurrah, UK inflation came in soft. CPI was flat at 3.8%, core fell to 3.5%. September is expected to mark a near-term peak in UK inflation, but as we showed you from that chart, it may rise again in January, depending on whether we're at 2% annualized or 3% annualized underlying. The market is expecting a 60% chance the Bank of England will cut rates again in December. Earnings growth, however, remains way too high. And if I was the Bank of England, I would not be cutting interest rates until we get a sustained fall in earnings. The labour market data remains weak and contradictory. GDP growth remains anemic at 1.3%, etc., etc. Stagflation turning into stagnation at the moment. All eyes on the budget. And while we're talking about the UK, let's talk about debt sustainability. Now, debt sustainability formula is there in front of you. The change in debt equals the existing stock of debt times the interest rate minus nominal growth rate minus the primary balance as a percentage of GDP. So what it's telling you is the sustainability is very dependent on the rate of interest you're paying on your existing debts and GDP growth. Bottom line is that to stabilize the debt, government must run a primary surplus large enough to offset the interest minus growth differential. If not, debt keeps on rising. So what does that mean for the UK? Well, as of now, the UK 10-year yield, which we will take to be a proxy for the yield that the UK is paying on its debt, is around 4.4%. Actually, the weighted average is around 4%. Now, sustainable UK long-term nominal growth, let's say it's between 3 and 3.5%. So that comprises 2% inflation plus 1 to 1.5% real GDP growth. Now remember, GDP can be broken down as productivity times labour times capital. So the OBR is set to downgrade the UK's productivity forecasts and consequently their growth forecasts. So given that UK debt is around 100% of GDP, as long as interest rates are around 4%, then that means in order to stabilise its debt burden, the UK needs to either lower interest rates, increase productivity, or run a primary surplus of between 0.5% and 1% of GDP. And when bond yields would back down 1%, you didn't need to run a primary surplus to stabilise the debt. Now they've risen enormously, and you do. Now, just as the OBR is downgrading productivity forecasts, we've got the AI revolution. And Bank of America is forecasting that AI will lead to a boost in productivity. Let's see. If that's true, then we'll see higher GDP growth and the debt in the UK will become more sustainable, and we need an increase in productivity because when you have an aging population, as the UK does, then what you find is it becomes less innovative. This is data from Japan, and you'll see that Japan's patent record in new industries has been declining. An aging population is less interested and less capable of innovating in new industries. The UK and the US both have aging populations. Now, the good news is that the UK government is committed to getting its finances under control, and as of March, when the OBR last did its forecasts, it was forecasting that the UK budget would move into primary surplus in 27-28. Now, since then, obviously the deficit has massively overshot forecasts, but in this budget, Rachel Reeves will be aiming to restore government finances to this path, and so put UK finances on a sustainable basis. But the background is that we now have debt to GDP levels of 100%, and we need to do more than simply stabilize the debt levels. We need actually to rebuild a fiscal buffer to enable us to react to the next crisis. So in my books, we should be running a larger primary surplus, but the reality is that there is not the political will for that. So I'm afraid Richard has had to go because he's struggling with a bad back for which he's had to go to hospital this week. So I will carry on. Now, onto the UK benefit system. And this, I think, is quite important. Now, a couple of weeks ago, we showed you this chart, which showed the number of people out of work and on benefits rising massively over the last 10 years. And this data was from The Spectator and led us to be quite pessimistic about the UK benefit system and its sustainability. But this chart is misleading. If you look at the cost of non-pensioner benefits, they're actually pretty stable. This looks at the number of people on out-of-work benefits. This looks at its cost, and the cost, is not rising on an unsustainable basis. So how is this chart, the number of people on benefits, compatible with this chart, which shows benefits actually under control? Now, we did show when we did this the second section a few weeks ago that actually the cost of non-pensioner benefits was not out of control, and that should have led us to conclude that there was something fishy about this chart. But what's going on is Department of Work and Pensions definition of what constitutes an out-of-work claimant has changed over time. Now, to give you just 3 issues, historically, a couple claiming benefits were counted as 1 claim. Now that's counted as 2. The state pension age has risen, so some people who would have counted as pensioners in the past are now counted as working age. And some people in the past who were out of work and receiving benefits were not counted as being out of work benefits claimants, whereas now they are. In particular, people just claiming child tax credits / housing benefits were not counted as out of work claimants. But now, under universal credit, they are. So Professor Ben Geiger of King's College has attempted to produce a time series of out of work claimants using consistent data definitions. And you're looking at the red line. Now, what it shows is that the number of people claiming benefits has been rising, but nowhere near as much as the previous chart from the Spectator would suggest. So bottom line is, the official data from the Department of Work and Pensions is misleading because the data series does not use consistent definitions. Welfare spending is not out of control. In fact, the proportion of adults of working age who are in work is close to a record high. So that suggests that the UK welfare system is not too generous. And over the past few years, the number of people claiming out-of-work benefits has not risen 80%, as the Spectator were alleging. A figure of around 22% seems more likely. So that is incredibly reassuring. Now, and when we did a segment on it previously, using the raw numbers from the Spectator, where we suggested that the UK benefit system is out of control. Actually, I'm entirely convinced by Chris Giles's analysis. The UK benefit system is not out of control. The costs are not forecast to rise over the coming years. So that's great news. And onto the EU. So we had CPI numbers for September, and month on month 0.1%, year on year 2.2%. That's all very good. Core CPI 2.4%. That rose. It's higher than expectations, and I think you'd say that it's still on track to go down towards the 2% target, but it's very slowly moving towards that target. And this is the latest forecast from the ECB, and you're looking at the blue line, and they're forecasting that EU inflation will dip below the 2% target in 2026 before rising back up towards target in 2027. Retail sales in the EU were 0.1% in August, 1% year on year, way below target, so not great. Eurozone consumer is not doing well. Industrial production down 1.2% month on month in August. Not great, better than expectations, but well down on July, year on year, 1.1%. High electricity costs in Europe and the UK are a fundamental impediment to industrial growth. Loans to companies growing at 2.9%, which is below expectations and down on August. Loans to households growing at 2.6%. Okay, not great. Money supply growing at 2.8%. Compatible with the 2% target, I'd suggest. Construction output growth year on year much worse than expected, 0.1%. So construction activity in the Eurozone stagnant. ZEW Economic Sentiment Index, which is a survey of professional economists, dipped down in October. It was forecast to rise, so not a great number, but still in expansion territory. Balance of trade, worse than expected, but much better than the UK. Citigroup Economic Surprise Index, 7.1, okay. Indeed, job postings index for Germany, that looks like it might be starting to turn down again. Wage growth 3.2%, perfectly compatible with the 2% target. That's not great. In France, the job postings index continuing to decline apace. The French economy is not doing well, not helped by political turmoil. Wage growth in France 2%. So in summary, in the EU, inflation was flat at 2.2% in September. Core rose further to 2.4%. Not great. Bottom line, stagnation. Expect the EU to continue cutting rates as inflation moves towards the 2% target. Okay, in the US, we've had delayed CPI numbers for September, and they were good. So CPI month on month came at 0.3%, below expectations. That's still high on a month on month basis. That's 3.6% annualized, but year on year it rose to 3.0%, below expectations of 3.1%. And the market took that well, and they're expecting the Fed to cut rates further again this week. Core rose at 0.2% month on month, and at year on year it fell to 3.0%. That's good news. Now, digging into the CPI numbers, you'll see that lots of categories are still growing very quickly month on month. Non-alcoholic beverages 0.7% month on month. Apparel, used car prices continued to fall 0.4% month on month. And finally, motor vehicle insurance is starting to fall, and that has been a key cause of elevated inflation over the past few years. Is that finally over? When we look at it year on year, there's a lot of categories that have grown much higher than 3%. Inflation has been helped by subdued oil prices. What have the effect of tariffs been? Well, tariffs are definitely having an effect on the price of durable goods. You'll see that historically, durable good prices have tended to trend relentlessly down thanks to productivity growth and outsourcing to China, whereas now they're rising well above trend. And consumer electronics have also risen well above trend. But the net effect equates to only around 5 basis points a month because of the relatively small weighting of durable goods in the CPI basket. Now, Goldman Sachs calculates that tariffs will have a cumulative effect of 1.04% on US prices in the core PCE basket, and that 0.44% of that has already happened, but a further 0.6% is due to come. So yes, tariffs are having an effect on US prices, but it's not huge. The good news about US inflation is that core services inflation is falling, even as core goods inflation rises. And as services are much bigger in the inflation basket, that implies inflation should continue to come down. Supercore inflation, which is ex-housing, is also falling. You're looking at the pink line. That is great news. Still too high, but at least it's coming down. CPI shelter, which is the blue line, is falling and looks set to fall. The Zillow All Rents Index is much lower than OER. So expect those two lines to converge at some stage and CPI shelter to keep on falling. Reminder, there are huge lags in OER, owner equivalent rent. Apartment List calculates that rental inflation in the US is actually negative, which implies that owner equivalent rents should keep on falling. And the reason that rental inflation is very subdued is that the vacancy rate is rising. Now, we know that Trump is deporting a load of people. Is that contributing to the vacancy rate and lower rents? So broad measures of inflation in the US all remain above 3%, but at least the trend is down. But how reliable are the US inflation statistics? This chart shows the percentage of US price series which are based on estimates rather than the real numbers. Essentially, Doge has cut a load of jobs from the Bureau of Labor Statistics, and there are fewer people to do the work, so they're relying more on estimates than on actual samples these days. Not good. And this is the forecast for PCE inflation from the Fed, and their forecasting. This is their latest forecast, and you see that they're forecasting overall inflation in 2025 to average 3.0%, core to be 3.1%, and then inflation to come down to 2.6% for both CPI and core in 2026, which will remain above target, but then for inflation to subside towards the 2% target by 2027, 2028. So the Fed forecasting inflation will keep coming down. Now, if it cuts interest rates too hard, then it's likely to miss this. Let's see. Now, a warning. Because of the US government shutdown, September CPI will be the last good quality inflation report until the end of this year. So even if the government shutdown were to finish today, there's insufficient time to allow the statisticians to collect enough data to put out the October report to be published on schedule on the November the 13th. The longer the shutdown goes on, the more delayed future inflation statistics are likely to be. It's estimated that it will take 3 months for the Bureau of Labour Statistics to properly catch up when the government shutdown ends. So this is manufacturing PMI. That's good. 52.2, much better than Europe, despite tariffs. Services PMI strengthening again, 55.2. That's a good number. That suggests that the US economy is operating at trend. That's composite 54.8, up in September on August, and that's a great number. US economy doing just fine according to the PMIs. Logistics Managers Index has turned down again. Not sure what to read of that, but the Michigan consumer surveys were all weak. So this is consumer sentiment subsiding towards all-time lows, current conditions subsiding towards all-time lows, consumer expectations subsiding towards all-time lows, inflation 4.6%, not great. The 5-year inflation expectations 3.9%, heading in the wrong direction. Fed won't like that. The RCM TIPP Economic Optimism Index, which is a survey of US consumers, getting worse, below 50. US consumers are pessimistic. Small businesses, that's a miss. They're becoming more pessimistic in September, but not a bad number in absolute terms. US consumer inflation expectations rising again, not great. Tariffs are hitting people's pockets and leading them to expect higher inflation. There's no initial jobless claims data due to the government shutdown. Indeed, job postings index continues to decline. Not good. Wage growth declining. That is absolutely compatible with the 2% target. So it looks like inflation in the US should be coming under control. Link up job postings, that is really not a good chart on the left. So what they're saying is online job postings continue to decline. Onto the nowcast, so Dallas Fed 2.2% down, but decent. Atlanta Fed strengthening 3.9%. Now, a reminder, the Atlanta Fed nowcast is particularly sensitive to imports and exports, so has been very distorted by the effect of tariffs. Let's see what happens. This is the one we like the most, which is New York Fed. It's saying 2.34% and steady. That seems about right to me. US economy doing just fine. St. Louis Fed estimates are much lower than New York Fed, but improving 0.6% annualized. Economic surprise index, pretty much. Economic data coming on out as expected, pretty much. Trueflation 2.5% and rising. So below the reported inflation numbers, but it's been that case for a while now, but rising, not good. Now, US car manufacturers are attempting to pass more of their tariff costs on to consumers. the price of the average new car in the US has just passed 50K. So this is the number of federal employees in the US, and you'll see that it's shrunk by 30,000, best part of, which is about 10% under Trump. So that contributes to job losses, the job loss numbers, and lower job openings. Now, the good news is that Trump is on a deregulation drive in the US, and he's aiming to unwind some of the capital requirements imposed after the GFC. And that should reduce US banks' capital requirements by around 140 billion, which would unlock 2.6 trillion in new lending capacity and is undoubtedly good for the US economy. Now, they were put in place for a reason, and the danger is, of course, that somewhere down the line, 15 years or so, you get a repeat of our banking crisis. But short term, very good for the US economy. Reminder, the US is running a deficit of 6% of GDP, and the debt trajectory is just frightening. So in the 3 months since Trump raised the debt ceiling, that's July, August, September to the 1st of October, the total US debt rose by 1.7 trillion. Absolutely astonishing numbers and frightening. The government now spends 23 cents out of every dollar of revenue on interest. This is totally unsustainable. So hence, gold is doing well. So in summary, we've had very little data in the US because of the government shutdown. The only numbers we've really had are inflation, which was reassuring. CPI rose to 3.0%, which was below expectation. Core fell to 3%. The Fed is expecting US inflation to subside towards 2.6% in 2026. Trueflation, however, is rising again. In general, what we're seeing is the US consumer is weak, but the economy is doing okay. The US economy remains resilient. Now, this is a very important section. So previously, we have been talking about how the US economy remains resilient, but the labor market is slowing, with the implication that slowing labor market will mean a slowing economy. Reminder, how a recession works is that you get job layoffs. As people lose their jobs, they cut spending. That leads to cascading job losses throughout the system. And the slowing labor market would therefore appear to portend a recession, a slowing economy, and a recession. But let's go through the Dallas Fed's employment growth model. So what the Dallas Fed looks at is what is break-even employment growth. How many jobs a month does the US economy need to create in order to have stable unemployment, i.e. for jobs growth to match growth in the available labor force? Only if jobs growth is below the break-even growth will there be rising unemployment, which would tend to be bad for the economy. And so their model comprises 3 components: growth in the total population, change in the participation rate, and change in the structural institutional ratio. That's quite a small effect, and that is the number of people unavailable to work because they're either children, the military, or in institutions. The participation rate is measured as the proportion of the non-institutional population who are in work. This chart shows the estimation of all 3, and what it shows at the top is population growth, and they estimate that has declined enormously between 24 and 25 due to the clampdown on illegal immigration. And also the change in labor force participation has gone negative. So what that adds up to is a huge drop in break-even employment growth. And the Dallas Fed now estimates that the US economy needs to create only around 30,000 jobs a month to match increases in the available workforce. So in their model, slowdown in US employment growth has not been due to a slowing economy. It's been due to the fact that there are fewer workers becoming available. Now, reminder that over the past 4 months, employment growth in the US has been very weak. And it's in August, it was 22,000, so below the 30,000. So that suggests actually there is a slowdown in the labour market, but these figures from the Dallas Fed suggest it's much less worrying than we thought previously. And unless the US economy starts actively shedding jobs, then there's not that much to worry about, frankly. So something to bear in mind in future. And on to China. So we've had a load of data out from China. As ever, the question is how much of it to believe. So quarter on quarter in Q3, Chinese GDP grew by 1.1% and 4.8% year on year, which is decent. Industrial production beat expectations at 6.5% year on year. So according to this, the Chinese economy is strengthening. Retail sales were 3% better than expected, but not great. Fixed asset investment minus 0.5% year on year. So this would suggest that the Chinese government continues to move away from their investment-led model. Unemployment rate, just don't believe this number, frankly, but 5.2%. Balance of trade remains very positive. Exports growing at 8.3% year on year. So China seems to be coping very well with US tariffs. It has found other markets to replace the US. So Chinese exports to US have been declining, but overall exports have been rising. Question is, how much of its exports to other countries are finding their way into the US via other channels? And one of the reasons the Chinese economy is doing so well is it's pegged to the dollar. So as the dollar's been falling, so the Chinese currency's been falling, which helps their competitive position in the world. Their imports have been rising much better than expected, all of which points to a Chinese economy that's doing all right. But contradicting all that, we have no inflation in China. Month-on-month inflation of 0.1%, year-on-year minus 3%, 0.3%, so deflation. So if you get inflation when there's an excess demand over supply, and seems to suggest a fundamental lack of demand and a weak economy. How is that compatible with 4.8% GDP growth? Loan growth continues to decline. Industrial profits beat expectations by a margin, 3.2%. That's a good number. As we've shown you earlier, the investment-led growth model appears to be at an end. So, and the West has stopped investing in China. You're looking at the blue line. Since 2010, both the US and Europe have been cutting their investment in China and increasing it elsewhere. Producer prices in China suggest a deflationary wave is about to hit global manufactured goods. That'd be great. So bottom line is, well, do you believe the numbers or not? If you believe the numbers, it suggests that Chinese economy is sort of Goldilocks. It's growing strongly with zero inflation. And onto one chart. Okay, so this is quite a complicated chart. When the Fed announces interest rates, it announces a range. So currently, interest rates are 4.0% to 4.25%. Now, what does that mean? What are those rates? Well, the lower bound 4% is what banks receive if they deposit funds with the Fed. And the 4.25% is the rate they pay if they borrow funds from the Fed. Now, generally, banks lend to themselves at SOFR, SOFR, which is the secured overnight financing rate, at somewhere in between the two. They will only borrow from the Fed if money's tight in the financial system and banks are charging them more than the discount rate, the red line, to borrow from each other. Now you'll see that starting in September, you're getting SOFR rates which are starting to breach the discount rate, and that has continued into October. Now, what that means is that banks are running out of ready funds with which to lend to each other, and rates in the market are tightening, and that suggests bank reserves are tight and that the Fed may have pursued a policy of QT to the point that it has drained too much liquidity from the financial system. So these are bank reserves. And so what's happened is not only has the central bank, the Fed, been pursuing QT, i.e. selling bonds into the market which are bought by banks, draining their reserves, but also the Treasury has been rebuilding the Treasury General Account by issuing a lot of T-bills, and that also drains bank reserves. This shows bank reserves as a percentage of assets, and it clearly shows that they have been falling recently. So what all that means is that the market is expecting the Fed to pause QT this week in order to improve banks' balance sheets and improve liquidity in the market. And if that happens, that would be good for bonds, and it would ease financial conditions by allowing bond yields to fall, which would mean it would also potentially be very good for all asset classes. Watch this space. Now, it's very difficult to keep track of what's going on with tariffs, so I thought I'd run through where we are. So the black line at the bottom is the effective tariff rate, and the green line is announced tariffs in the US. And the black line lags the green line because of implementation delays. So tariffs have been a very effective policy for US tax revenues. Receipts are running at 30 billion a month, or around 1.2% of GDP on an annualized basis. That represents actually quite large fiscal tightening. But the headline tariffs are much less punitive than you might think. So, for example, Trump announced additional tariffs of 10% on Canada this week, but 90% of Canadian exports to the US are in basic goods which are exempt from tariffs. So that means that even after the 10% rise in tariffs, Canadian exports actually have an effective tariff rate of only 3%. And you can see that effect here. This chart was produced before the additional 10% tariffs, but you can see on the x-axis that only 10% of Canadian exports to the US are subject to tariffs. Contrast that with China, where 95% of Chinese exports to the US are subject to tariffs. So effective tariffs on Chinese goods are over 40%. Tariffs are primarily imposed on finished and semi-finished goods. So if you export raw materials to the US, you face a much lower rate of tariffs. But even effective tariffs of just 3% have had a clear effect on Canadian exports to the US. They've fallen quite sharply. tariffs are not good for trade. Effective tariffs on China are a punitive 40%. The EU, they're 9.1%. UK, 5.75%. Better, but still a lot higher than they were. So actually, contrary to what I said earlier, the tariffs on some basic goods, such as iron and steel, where Trump is protecting US industry, are very high. But things such as other raw materials, such as oil, there are no tariffs. But you see that very high tariffs on basic manufactured goods like umbrellas, etc. Now, when you look at the US balance of trade, well, I can't see much of an effect there. It doesn't look like the US has actually reduced its imports very much, although imports from China have clearly declined, as they have from the EU. Imports of machinery, boilers and mechanical appliances have actually surged post-tariffs. So people are simply absorbing them. But if the purpose of all these tariffs was to protect US manufacturing and lead to a resurgence in US output, well, that really hasn't happened as yet. Lots of US manufacturers import components and has added to their costs. Now, when we look at the revenue impact of tariffs, well, we said earlier that that's been 1.2% of GDP. And if you look at the purple line, you'll see that in nominal terms, the US deficit is in line with 2024. Now, earlier in the year, it was substantially higher than 2024 and is now in line. So tariffs have improved the deficit, but it's still enormous. And when you look at the latest deficit forecasts, well, the CRFB, the Committee for Responsible Federal Budget, is suggesting that it will continue to run at around 6% of GDP for the foreseeable future, which is just an astonishing number. 6%. Governments tend to run 6% of GDP deficits at the bottom of very bad recessions, not when the US economy is growing adequately. What will the deficit be during a recession? It will undoubtedly be higher. And at what stage will the bond market vigilantes move to impose fiscal discipline on the US? So when you look at the impact of tariffs on consumers, the effect is to raise the price of goods, which will result in lower consumption. So car manufacturers are expecting car sales in the US to stagnate in the coming years. And although there will be a net rotation of car sales from foreign manufacturers to US domestic producers, overall, total new vehicle sales will drop, leading to a net fall in US car production of 300,000 per annum, i.e. tariffs are not good for US manufacturers or US consumers. Goldman Sachs estimates that the US consumer is currently paying only around 30%, 37% of the tariffs, and that will eventually rise to 55%. So currently, US businesses are absorbing the majority of the tariff cost. They expect US businesses to pass on more of the tariffs in the future. So bottom line is actually tariffs appear to have had relatively little effect on trade or on inflation. The cumulative effect on inflation, as we discussed earlier, is about 1.04% spread over a number of years. It has, however, been an effective tax on American consumers, raising around 1.2% of GDP per annum. which is a big fiscal tightening, markets have also entirely shrugged off tariff uncertainty and the fact that impose is a tax on US businesses. You've seen that currently US businesses are absorbing 51% of US tariffs, moving to 22% of tariffs, but stock market keeps on rising. Bottom line is, for consumers, it's bad news. It raises their costs, and as the poor primarily purchase goods and the rich can purchase services, it will primarily have an effect on poorer income consumers. And last special segment this week, private credit ratings. Now, we talked about this a few weeks ago, how private credit markets have grown rapidly in recent years. And so you see absolute size, these are big bars. This is capital, this is private debt under management. So it's grown to 1.6 trillion in 2023. And so a couple of weeks ago, we did a segment about how the failure of United Brands had led to concerns about the declining credit quality in the private credit market. And this chart shows you how banks have poured money into private equity and private credit over the past few years. Has that massive surge led to declining credit quality? Now, the trouble is, it's difficult to know what the credit quality is of these private loans because most of it doesn't have credit rating. But we can get some sort of idea from looking at the private credit held by US insurers, because US insurers have to have their private credit rated. Now, previously, this was largely done by the big three, Moody's, Fitch, and S&P. But over the last 5 years, insurance companies have increasingly moved to having their private credit loans rated by small specialist agencies. These include AM Best, Egan-Jones, HR Ratings, and Kroll, amongst others. So the big question is, has this led to a net reduction in credit quality? So the analogy is with the GFC, where credit rating agencies were conflicted and were giving poor quality loans very high ratings because they were essentially paid to do so. Now, the National Association of Insurance Commissioners, the NAIC, has its own ratings agencies, the Securities Valuation Office. So what happens when loans move from being valued by the SVO to private credit rating agencies? The answer, according to the NAIC, who did a paper on this, is that the private rating agencies, PLRs, increase their credit rating on those loans by an average of 2.74 notches, which is a lot, i.e., private credit rating agencies are giving much better ratings to these loans. And when you look at the scales, 3 notches is a lot. It may move a bond from being lower medium grade to upper medium grade or high grade to prime. 80% of loans which move from an NAIC rating to a private letter rating received a credit rating upgrade, and only 5% received a downgrade. But defaults are currently low, and actually they've been falling over the past 12 months, so there's not really much evidence of systemic problems. And after initially spiking after the failure of First Brands, etc., high yield bond yields have actually declined again. So the market seems unconcerned. So what this tells us is that if you extrapolate the experience of insurers to the wider private credit market, it would seem that there are reasons for concern that the market is moving the way of the mortgage market pre-GFC, i.e., credit ratings are giving far too generous ratings for these bonds, leading to excess lending. But that doesn't mean we're anywhere close to the crisis. I see very little reason to be concerned here currently. If we get a slowdown in the US economy, then that may change. But currently, the US economy is doing okay. What it seems to suggest is there's more risky lending in the system, which would cause problems if the US economy slowed down. And onto Inflation Watch. Now, I prepared a number of special segments, particularly on oil and the basis trade. Thank you to our viewer Andy, but we're not going to have time to go through them this week. I will do them next week. So quickly onto Inflation Watch. We now have all the numbers for September, and they're not great actually. UK is an outlier in that inflation in the UK fell in September. Everywhere else in the world, it rose, including in China, where CPI remains in deflation. So central banks are assuming that is a temporary blip back up in inflation in September, and inflation will start to resume its descent in the coming months. Let's see. For what it's worth, UK trueflation is showing a sharp decline starting in October, which would be great news. But as we've discussed many times, and the reason I don't report UK trueflation anymore is the historic series is absurd. UK was not in deflation last November. Now, the other thing is, I noticed this when I was preparing the weekly. The EU inflation was 2.2% in September, but then when I was looking through the data, it showed European Union inflation was much higher at 2.6%. So what's the difference between EU inflation and European inflation? Well, EU inflation is for countries which are in the European Union and in the Eurozone. European Union inflation is for countries which are in the EU, including the 6 countries that have their own currencies, which are Denmark, Sweden, Poland, Czech Republic, Hungary, and Romania. And Bulgaria will be joining the EU on the 1st of January 2026, but not the Eurozone. So it will also have its own currency. So you can see this chart shows in blue European Union inflation and in grey Euro area inflation. What it shows is inflation for those countries that have adopted the euro is consistently lower than for the wider European Union. So the euro has imposed monetary discipline on the Eurozone. The question is, at what cost? Because Eurozone GDP growth has been anemic. So the question is, has the monetary discipline been too great? In summary, September was a bad month for inflation everywhere except for the UK. And on to Recession Watch. So when you look at the US housing market, there are far more sellers than buyers, which should equate to falling prices, although prices are very sticky on the way down. What you tend to see instead is declining transaction volumes. And this is the delinquency rate on credit cards, and that's the absolute number. So 1.2 trillion of US credit card debt is now considered to be in delinquency, and the number of credit card accounts which are more than 90 days in delinquency, has now hit 12.3%, which is almost as high as post-GFC. US consumers are not doing well. Subprime auto loan delinquencies also continue to rise. So the car is the last thing people want to give up. So that suggests real stress in subprime borrowers. But reminder, subprime borrowers are relatively small proportion of overall US consumers, less than 10%. And prime delinquencies are rising but are not elevated. 26.4% of non-prime student loan borrowers are in default. That is a big number. The default rate for prime borrowers is only 0.2%, however. Buying conditions for cars, houses and large household durable goods remain near record lows. That's not great. And 67.6% of Americans are living paycheck to paycheck, up 10% over the past 18 months. So all these charts show that the US consumers are not having a good time, but we know that 50% of all US consumer spending comes from the top 10% of US earners. So stress at the bottom end of the distribution may have surprisingly little economic effects, may have surprisingly little effect on overall consumption. Inequality is growing in the US. Now, this is interesting. This is the number of Federal Housing Association loans given to immigrants without permanent residency. And you can see it had been steadily growing and now it's collapsed. And that removes demand from the housing market and should lead to lower house prices. So in summary, well, the US consumer is struggling, but as it's an increasingly unequal society, how much of an economic effect will that have? Not much. It should have a political effect, but will it? Question mark. And on to good news. So the current generation of lithium-ion batteries have been really transformative for electric vehicles and for energy storage everywhere. So in our house, we've installed 22 solar panels and a 1,000 kilowatt hour battery, which is, really quite small, and it fits easily onto the wall of the garage. But if we are to have extend the range of electric vehicles, etc., then we need to improve the energy density of lithium-ion batteries further. Now, lithium-sulfur batteries have the potential to store 2 to 5 times as much energy as a current lithium-ion battery for the same weight. However, they have proved to be unstable because of the expansion and contraction of the lithium cathode during the cycle, making the battery structurally unstable. Now, you'll remember when we've talked about this before, how in a lithium-ion battery, lithium ions physically move from the anode to the cathode and back again during the charge and discharge cycles. And they have to do that without physically changing the volume of the battery, of either the anode or the cathode, in order for the battery to remain stable. Now, researchers in Australia appear to have solved this problem in lithium-sulfur batteries by adding glucose to the cathode, which stabilizes the structure of the sulfur cathode and provides pathways for lithium ions, allowing them to move in and out without changing the size of the cathode. And they were inspired to do this because of actually experience from geological sediments where sugar-based substrates had been shown to resist degradation by forming strong bonds in with sulfides, and they have run this battery through 1,000 cycles, and the glucose has not deteriorated. So that means that we could have lithium sulfur batteries which would be cheap and have higher energy density, and you'd be able to use them for many cycles. All great news. So, concluding comments, bond markets appear to have reached an inflection point. Fingers crossed. I've got this totally wrong. I'll say it again and again. I've been totally wrong on this cycle, expecting bond markets, bonds do well, and they've been a total disaster, and I have been underweight equities, etc., etc. Equities continue to grind higher. Precious metals have hit a near-term peak. Is that a pause in the bull market or something more significant? Richard will give you his expert opinion, but unfortunately Richard has had to leave us. We will be back next week when Richard will return with his opinion on what's happened over the coming week. So the Fed is expected to cut rates later this week and possibly pause QT, which could extend the bull market in everything. All eyes on the budget in the UK coming up. Thank you all for watching. I hope you're all doing much better than me. Not difficult. I'll hope to see you all again next week. In the meantime, it's goodbye from me, Keith Jordan, and also goodbye from Richard Wheater, who's gone to lie down because his back's playing up. Please can you press like and subscribe to the channel. Thank you. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.